I'm assuming that most people in this room at this point have come across behavioral finance in some guise or another. Quite a lot of you probably have a copy of Daniel Kahneman's Thinking Fast and Slow, languishing, nearly unread on your bedside table. I have two big problems with behavioral finance, which might sound strange as someone who's basically staked his career on it. One is a lot of behavioral finance is enormously impractical, and two is a lot of it is unduly negative. Now, we often see these lists of biases. Here's a list of 10 biases, 20 biases. I actually found a website with 169 different biases of psychological decision-making listed on it, which is kind of nice, right? It's nice to know that we know so much more about how foolish humans are than we used to. But what does one do with a list of 169 biases? It's thoroughly impractical. And every one of these is pointing out, as humans, how foolish and how stupid and how irrational we are. And I'd like to put it to you that if we're going to use behavioral finance to improve decision-making, which is what Centapse is all about, and what I think, indeed, the entire industry should be all about, we need to see things through a simpler guise. Every single decision that we as humans make is made in the present. And in every single decision, there is a tension between two quite simple things. One is, what is the best decision for me to make for my objectives? And two is, what is the decision that makes me most comfortable right now? And as human beings, we very often reach for the decision that makes us comfortable at the expense of the decision that is right. So let me put this in an investing context for you. Here is a very stylized version of a cycle of emotions that a human might go through. I'm sure you've all seen versions of this before, but I just want to walk you through a few of the emotional states along the way and point out at how these biases can be viewed through this simple lens. The starting point invariably is reluctance. Most people are very reluctant taking money from somewhere safe and putting it somewhere risky. It seems like a negative trade-off. Why on earth would I do that? Why would I move my money from cash and put it into investments? Of course, viewed now, at the present, it is a negative trade-off. But over 20 years, you might feel slightly differently. Because if you leave your money sitting in cash for the next 20 years, you're going to have been recklessly conservative. So actually, you should get invested. But people are reluctant because it is an uncomfortable thing to do. And so people sit with too much of their money languishing away, doing nothing for long periods of time. What they have done is they have purchased emotional comfort at a cost of long-term returns. As markets go up, we start to get excited. What pulls us out of cash? Well, stories. People don't buy risk-return trade-offs. People buy stories. They buy narratives. And when the markets have been going up for a while, now we have a narrative. Well, the world is a nice place. Look how well everything is doing. Now I start to feel comfortable buying. But of course, when I buy up there, I am once again assuaging my need for emotional comfort at a cost of long-term returns, because buying high is going to be lowering my long-term returns. As markets turn down, we see something very interesting. People enter a state of denial. Now, this might sound like a really psychobabbly thing to put up there, but there's enormous amounts of evidence for this. We know, for example, that if you monitor the frequency with which people log in to check the value of their investment accounts, that if markets are going up, people start to log in more and more frequently. Because every time they do, they get great news about what brilliant investors they are and how much wealthier they are. And for those of you who live in London, I suspect over the last 5 years, there's been a whole swathe of people who sit at home on the weekends desperately hitting return on Zoopla to see how their house price go up minute by minute. When it turns down, we don't like to be faced with information about the fact that we are poorer. We don't like to be faced with information about the fact that we made a bad decision. So we ignore the information. Now, there's been an awful lot of this confirmation bias going around in political circles recently, and I'll touch on that again a bit later. But this is costly. If we shield ourselves from information at the time it's most useful, what we are doing is impairing our decision-making, again, because it makes us comfortable. And as markets go down, we hit fear, we hit desperation, we hit panic. And the fear and the pain of selling at a loss gets bigger and bigger and bigger. And we're reluctant to do it because turning a paper loss into a real loss is something that is psychologically very costly. But at this point, something else happens. Not only do I have the pain of selling at a loss, but I also have the pain of holding on. Because if my wealth has dropped by 25% on the way down, And I'm terrified that if it gets any worse, I'm going to have to sell the house, sell the car, sell the kids, whatever it may be. I don't want to hold on anymore. I run out of my reservoir of emotional liquidity, and I capitulate. Now, classical finance theory says that's irrational. It's stupid. We told you not to sell at the bottom. Don't do it. Actually, it's not irrational because you get something very real in return. If you sell at the bottom, you get relief. You get to move on with your life. And that is something very, very valuable. But again, what you are doing is you are buying emotional comfort at the cost of long-term returns. And this is very, very expensive because not only do you lose all the way on the way down, but you cannot go from capitulation back to optimism. You first have to go through despondency, depression, apathy, indifference, and finally, you end up back at reluctance. Our emotional state as humans at every stage, at every decision we make, is one that pulls us away from a good decision to the right decision. Now, I want to be a bit less negative about this. I want to put us into a practical path here. I think that we can all improve our decisions by design. If we look, there is not a single decision-making process that we cannot, as humans, design a path to let us make better decisions. And to do so broadly, we need to do three things. One, we need to take control of our environment. The environment in which we make decisions influences those decisions dramatically. Two is we need to build for ourselves what I call decision prosthetics. These are the beeswax and the ropes, the tools we can bring along with us that help us to make better decisions. And three, we need self-knowledge. We need to learn from our mistakes. We need to understand where we make mistakes and where and how we improve them. Now, I'll touch briefly on each of these three areas just to give some examples. If you're an investor, and you're trying to decide, do I invest in the equity market, for example? It matters an awful lot how I portray that decision to you. So here is a chart that shows the annualized rolling 10-year returns from the MSCI World Equity Index. So if you are an investor that has a 10-year horizon, you have a time horizon of 10 years, and by that, what I mean is over 10 years, you're pretty sure that you're not going to be forced to sell at a time of your choosing. You get to choose when to sell. And you're trying to decide, do I invest in equities? Then this is a pretty good way of viewing information. It says, over 10-year horizons, what should I expect to see in terms of risk and return? Now, bear in mind, this is a 100% equity portfolio. It is extraordinarily risky. And when I was working for a large bank not that long ago, every time I showed a slide like this, they would make me put up a statement that said, past returns are no guarantee of future returns, and there was a whole list of disclaimers in font size 4.5 that I had to put in the bottom here. It is a risky investment, except that when you look at equities through a lens that is aligned to the decision this decision maker is trying to make, it doesn't look that risky anymore. Randomly, I could pick a point here, and the average is about 11%. Now, that's 11% per year, every year for 10 years. That's a pretty good outcome. Only briefly, in the biggest moment of cataclysmic catastrophe that any of us have ever lived through, does it even briefly drop below zero. And the right conclusion to take from that is not panic, I better get out of this thing right now. The right conclusion to take from that is don't sell now. Here's the problem. As investors, we do not live in a 10-year time horizon. We live today. Every decision we make is made today. And so we don't see this. Our experience of the market is more like that. This is exactly the same data set, just viewed through a shorter time horizon. And as humans, our emotional time horizons are always shorter than our actual time horizons. And if we don't take control of the information that is coming into us, we run the risk of making poor decisions. We run the risk of buying emotional comfort for me today at a very expensive cost to long-term returns. What can we do about it? Well, the single best thing you can do to improve your decision-making is to make fewer of them. If we all made less decisions, the chances that those decisions would be emotionally driven would be much, much shrunk. Now, that sounds impractical, but there are ways in which we can do this. So the best way is make as many decisions as you can ahead of time. If you can sit down and think through how you would like to behave in the future, write down those rules, and basically pre-program your future behavior, what you're doing is you're making a whole raft of decisions, at a time when you are emotionally calm, at a time when you are able to see how I would like to behave, how I would like to think for the long term. Now, I've called this a decision constitution. And I use the word constitution deliberately because in the same way as a country will use a constitution to govern its behavior in times of stress, in times of chaos, these are the things that we do not want to be doing no matter how stressed and nervous we get. We should, as individuals and companies, be using a constitution to govern our own behavior in the time. But it takes effort. None of this comes for free because every type of decision requires its own constitution. And a constitution should have a number of components. It should have a statement of what you believe, what assumptions you're making, because otherwise, how do you know whether these things are coming to pass when you're in that moment of stress? It should have a definition of decision scope. So, for example, I, as an investor, came to the conclusion years ago that I have absolutely no privileged knowledge about where forex markets are going. So, after being burnt a few times when I thought, well, I'll just take a quick punt on the yen or I'll buy some dollars or whatever, I came to the conclusion this was foolish. This was outside what Warren Buffett would call my circle of competence. If something is outside of your circle of competence, stop doing it. So I wrote for myself a rule, and I actually wrote it down, which is basically, thou shalt not take any FX positions. And post that, you don't get tempted by it. Scheduled actions. You can make an awful lot of decisions as an investor that you can then automate. You can say, if this happens, I want to behave in that way. Every year, I want to rebalance in this way. Every 3 months, I want to do this. The more decisions you can take away from yourself at the moment, the better you're going to do. Contingency plans. January this year, the markets were plummeting. And everyone was running around going, oh, the markets are dropping. I didn't see that coming. Which is kind of interesting because the one thing we know is that it is not a question of if markets will drop. It is a question of when markets will drop. It is utterly predictable that at some point markets are going to drop. If something is utterly predictable, then it's easy to prepare for it. We can all draft contingency plans for a whole bunch of things that mean at those worst moments of stress, we're best able to take account of things. Building processes. And all of this requires essentially writing down a set of rules and then figuring out how I can start to automate my own future self. And one of the things we want to do is simply to do less than you think. Now, here's a question. To do well in the financial markets, you have to buy and sell often. Now, some people believe that to be true. Some people believe it to be false. Warren Buffett's, famous, my favorite holding period is forever, is at one end of the continuum. There are other people who genuinely think they have to be jumping in and out of the markets all the time. I have my own opinions on where on that spectrum I think I should be, and everyone should be in a different place depending on their skill and their beliefs and their approach. But what is generally true is this. Wherever on that continuum you are, the right amount of activity is less than you think it is. Because as humans, we are prone to an action bias. We are prone, particularly when we are stressed and emotionally charged, to want to do something, just because doing something makes us feel better. So here are some data that we collected in 2012, back when I was at Barclays. And we asked 2,000 high net worth people all around the world that question, and a whole bunch of others, one of which was, I buy and sell investments more than I should. Now, if you answer yes to this statement, it is an admission of guilt. It is an admission of compulsion. You're not saying, I believe I should do it a lot. You're saying, I do it more than I am able to control. And what turns out to be really interesting here is that the more you think you have to do, the more it becomes an addictive process. People who engage in uncertain environments, in random environments, are tempted constantly to be doing more than they are. The more you can step back from the markets, the more that you're going to face this, the less you're going to face this particular bias. So we have to provide tools that essentially help us to step back. When we're in a moment of stress, there are two extremes. One is we're all tempted to flail around and run around like headless chickens and do too much. The other one can happen too, where we curl up in the fetal position and we roll around on the wall on the floor and do absolutely nothing for a while. Those are both dangerous. And no matter how well you may have crafted your decision constitution, there will always come times when the plan doesn't work anymore, when you have to throw it up in a ball and go, now what do? I didn't see this one coming. And this is where we can learn from other areas, from other industries. The military, for example, has this aphorism that comes from an old Prussian commander, von Moltke. No plan survives first contact with the enemy. Or as Mike Tyson slightly more pithily puts it, everyone's got a plan until they're punched in the mouth. The military has had hundreds of years through trial and error to build tools and processes to deal with this. Now, one of those is what they call mission command. It goes by different names in different military organizations. But essentially, what it is a 5 or 6 or 7 step, depending on where you are, decision process that is deeply drilled into every single person through training, through repetition, through assimilation, etc. So that when you find yourself in that situation, when the plan has gone out the window, when people around you have been shot, that you can start to make a clear decision. You don't have to have made a decision earlier, but you do need to have trained yourself earlier. You do need to have built your processes for how do I make decisions under stress. And we can think of these as decision handrails. And they broadly come, it depends on what your decision-making process is, but broadly it is, am I able to tell what it is I'm trying to achieve when I'm under stress? Because often we start to make decisions that have nothing to do with where we're aiming for. What do I actually know? Stop and test the intelligence of the environment. What are my options? How do I evaluate them? And then perhaps most crucially, pause. This is something very often left out of decision processes. We review it, we come to a decision, it feels like a comfortable decision simply because it's our decision, and we push go straight away. Now, cooling off periods. The medical world has been building checklists for quite some time now, and it turns out that merely having a 5 or 6 point checklist that goes, is it the left leg that we're cutting off? Yes, no. Taking people through 5 or 6 simple things and consciously paying attention to those things in the moment of crisis costs you maybe 20 seconds of time, but can save you many, many calamitous errors. And there are many versions of this pause point, but essentially, to build an intentional cooling off process into your decision making is absolutely crucial, whether you're investing or making corporate decisions or whatever. And somewhere on the continuum of I'm going to stop and ask myself inside my head, is this a good idea? Versus at the other end of the continuum, I'm going to write a 30-page PowerPoint presentation and present it to 20 people over a 2-week period. Somewhere in the middle there is the right cooling off decision process for every decision. And we need to do the work to try and unearth, how do I build a process that enables that to happen? And then the last one is learn. Very often, and particularly in uncertain and unruly environments, something happens, we blame it on someone else, and we move on. The failure to learn from mistakes is one of the biggest problems of people not learning and not becoming better decision makers. Because unless we learn from our mistakes, we can't improve in any way. And that brings me back to confirmation bias. So here's just one example. There are many, many examples of confirmation bias. Here's one that is particular to investing. It was an experiment that was done, I believe, in Korea. They asked people about stocks. Are you a strong buyer, a strong sell? Where do you sit on this continuum? And what they did, they put them in an artificial trading environment, and they flashed information on tickers ahead, little headlines that people could click on and get the news. And what it turned out, they looked at what people clicked, and people overwhelmingly clicked on stuff that reinforced what they already believed. Now, the newspapers have been full of this, post-Brexit, post-Trump, etc. We as humans have a phenomenal ability to self-deception because not finding people who disagree with us is psychologically uncomfortable, so we exclude them. We don't read the newspapers that disagree with us, and so we walk around in these bubbles. Now that, of course, has political consequences, but it has simple consequences for every single decision we make. Because when we're making decisions in an investment context, we are effectively placing bets against reality. And if we misjudge reality, it means that on average we are going to lose. So unless we are able to combat our own confirmation bias by, for example, using devil's advocate, by asking people, play the opposite side, tell me where I might be wrong, by using group diversity, there's all sorts of evidence that in a group or a committee context, that diversity is one of the most fundamentally important things we can have. Because if you don't have diversity, all you have is a supercharged single person. who gets really self-centeredly more and more opinionated as everyone agrees with them. Identifying reasons for and against. Simple tools where you could go, this is what I think. Now let me try and take the other side. Now let me try and take both sides. These are the things that can help to unbias ourselves as humans. The problem is that this isn't rocket science. These are very simple, but they take effort. And as humans, we don't like to go through effort to correct things that feel comfortable to us. We would rather go unbelieving. I'll just give one more example here. In the internet bubble, there were books coming out every few months. Dow, 40,000. Dow, 50,000. The top one came out with the title of Dow 100,000, just a few weeks before it all came tumbling down. Now, the interesting thing about this is you think, wow, those must have been foolish, utter rubbish in those books. If you actually read them, they're pretty articulate. They're pretty well reasoned. It's a human ability to construct a rational, articulate, well-reasoned rationale for absolute nonsense is amazing. And we all do that to ourselves all the time. If we really want to get under the skin of our own decision-making, we have to understand ourselves. Know thyself. And there are various ways of doing this. We can use psychometric testing to understand our personalities. We can walk around with Fitbits and measure our step count, get information on our real behavior. But tracking your decisions, taking an objective view, asking other people to tell you where you're going wrong, these are the things that help us to be really powerful. Now, in 1997, this man, Daniel Kahneman, the chess grandmaster and world champion at the time, played IBM's Deep Blue and lost. And so for the first time, we have the situation where the best chess player in the world has been beaten by a computer. So you'd think, right, well, now the best chess player in the world is a computer, right? Well, actually, no. It turns out the best chess player in the world is not a computer. After he had unrolled himself from the fetal position, Gary Kasparov started a new form of chess, one he called centaur chess. Man plus machine plays man plus machine. And it turns out that a reasonably good chess player, equipped with a reasonably good chess computer, if they worked well together, can take on and beat a grandmaster or can beat the best computers in the world. Because there is stuff that humans do well, and there is stuff that machines do well, and it's not the same stuff. So the best chess player in the world today is a centaur, a combination of a man working with a machine in tandem. And this, I think, is where we need to get, because everything I've been talking about here is humans make mistakes. On the other hand, humans have incredible intuition and incredible ability to assimilate information and can do things really, really fast that computers can't, and vice versa. So if we design these systems, the decision constitution, the handrails, the information design, what we're effectively building are decision prosthetics. We're building tools that can help us as humans without replacing the human, but enhancing the human to make better decisions. And the sweet spot for better decisions, and this is true broadly, not just in investing, although I think in investing is a core application of this, is in this intersection between three buzzwords of the day. Data. Could be big data, could be medium-sized or even small data, but the use of data to rapidly understand and tailor and personalize the decision at hand. Digital technology as a mechanism for delivery. Can we reconfigure information in a well-designed way that portrays information to people in a way that's aligned to their objectives, rather than people looking at short-term information and aiming for long-term goals? And behavioral design to try and build these systems, these prosthetics, these centaurs, as enhancing rather than failing.